The most important step, and the one that is most often overlooked, is to research prospective clients thoroughly before extending payment terms of any kind. Understanding a client's financial health and payment history before you sign a contract is far more valuable than attempting to recover a slow or disputed payment after the work has already been delivered. A practical and widely used approach is to run a formal credit check through a business credit reporting agency. Two of the most recognized resources in this space are Dun & Bradstreet and Creditsafe. These agencies provide detailed reports covering a company's payment behavior, financial stability ratings, and any history of delinquent or disputed payments, all of which should inform your decision before you agree to net 30 or net 60 terms. If you are finding this video helpful, please make sure to subscribe and hit the like button so we can continue bringing you more content like this. Feel free to ask your questions in the comments below. Invoice immediately upon delivery. Every day of delay between completing the work and issuing the invoice extends your collection cycle unnecessarily. Prompt, accurate invoicing sets a professional standard and moves you closer to receiving payment without losing valuable time. Take a closer look at whether your standard payment terms truly reflect the nature and scale of your engagements. If your current terms are net 30, consider whether net 15 is commercially viable for your business. Tighter terms establish clear expectations and bring cash in at a noticeably faster rate. For substantial projects, it is standard professional practice to require a deposit before work begins. This reduces your financial exposure from the outset and ensures that adequate funds are available to cover the initial costs of delivery. You might also consider offering an early settlement discount. A modest reduction for clients who pay within 10 days gives them a genuine financial reason to prioritize your invoice, and that small incentive can make a meaningful difference to your cash position. Please note that the Accounts Receivable Aging Report is one of the most powerful tools available to any business operating under accrual accounting. It gives you a clear, organized view of every outstanding invoice and how long each one has been unpaid, so you can follow up before a balance becomes seriously overdue. I have many videos about accounts receivable. I'm posting the link to the playlist here and in the description below. In QuickBooks, this report can be generated within seconds. You can also configure automated payment reminders to go out to clients as their due dates approach, which significantly reduces the administrative burden of manual follow-up. Finally, any business operating under accrual accounting should give serious consideration to establishing a business line of credit. Think of it not as a loan, but as a financial safety net, one that gives you access to short-term funds during periods when your incoming payments and outgoing obligations are temporarily out of alignment. Voila! When client due diligence, disciplined invoicing, structured payment terms, and consistent receivables management are all working together, you're no longer simply reacting to cash shortfalls. You're managing your financial position with intention and control. Excellent! Remember, profit tells you whether your business model is working. Cash tells you whether your business can keep operating. Both deserve your full and equal attention. If you want to learn more, watch my video Cash Flow versus Profit: Why a profitable business can still run out of cash. Thank you all so much for watching, and I hope to see you all again in the next video.